Hello, and welcome to Macro Minutes. During each episode, we will be joined by RBC Capital Markets experts to provide high-conviction insights on the latest developments in financial markets and the global economy. Please listen to the end of this recording for important disclosures.
Welcome, everyone, and happy Thanksgiving to any of our U.S. listeners. This is the November 21st edition of Macro Minutes, which I'm calling Riding the Chop. I chose that title because we've had some pretty large price swings over the last few weeks, but ultimately they don't really seem to have gone anywhere. Just for some context around that, since our last episode 2 weeks ago, U.S. two-year yields have traded in a 30 basis point range. The day of the October CPI release last week alone saw a 20 basis point rally, but for all that movement, we're actually within 2 basis points of the close on the day of our last recording as we sit here to record this week's edition. So anyway, we've got a great slate of experts today. We're going to start with our U.S. economist, Mike Reid, to talk about U.S. economic data. Then I will jump back in a little bit, talk about how the U.S. Rate narrative has shifted heading into year end. Then we'll have head of North America's rate strategy, Jason Dahl, to talk about swings in BOC pricing and its impact on curves. And then finally, we'll head over to head of UK and European rates and economics, Peter Schaffrik. He's going to discuss fiscal plans and whether central banks are going to remain at the center of the European market discussion. So with that, let's turn it over to Mike Reid to talk a little bit about US economics.
Great, thank you, Blake. This week I want to focus on the consumer ahead of Black Friday. And last episode, we did highlight some of the weakness we are seeing in the labor market. The unemployment rate ticked up. We're seeing the duration of unemployment rising and continuing claims continuing to climb. And I just want to point that out for broader context for what we expect to see heading into 2024. Just last week, we saw the October headline retail sales report, and that contracted for the first time after 6 consecutive months of gains. And this is particularly notable because this is really the first month of data that shows the impact of federal student loans resuming for consumers. And next week, we will see the fuller picture in terms of spending from the personal income and spending report. And there it's worth highlighting that when you look at real spending and real incomes, for the past 4 months, spending has outpaced incomes. And what's worrying there is that even before you account for the impact of student loans, the consumer is really starting to show signs of weakness. When you look at what's been driving the strength in consumer spending, we saw the personal savings rate fall to 3.4% in September, and that's from a high of 5.3% in May for 2023. So really a lot of that spending was driven by the savings rate moving lower. Add to this the increasing reliance of credit card spending for consumers. We saw the revolving consumer credit outstanding continuing to grow. And what's more worrying is that if you look at the New York Fed report on household debt and credit, that showed that delinquency rates increased across all product types except for student loans. But what's really important about that data point is the report only covers up to Q3. So it does not yet show the broader impact of those federal student loan repayments resuming there. And guess what? The groups that saw the fastest pace of serious delinquencies for credit cards and auto loans were the 18 to 29-year-olds and 30 to 39-year-olds. Those are the 2 groups with the highest burden of student debt. So really, this is why we expect to see consumers pull back heading into the holiday season here, and we do expect a notable downshift heading into the first half of 2024. And again, the thing to keep in mind is this is all happening in the context of a relatively strong labor market. But as the labor market continues to deteriorate, and we do expect to see job losses materialize here heading into 2024, that's just going to add further pressure to the consumer here.
All right, thanks for that, Mike. So on the U.S. rate side, I do think last week's CPI print marked a fairly important pivot point for the U.S. rates narrative. If you recall from August to basically the end of October, I think markets were really looking at the world through a very bearish lens, grabbing on to data beats, to all the supply developments we had, any kind of hawkish Fed speak we were getting, and really any other bearish impulses. Shorts were very quick to add, slow to take profit. And at the same time, I think dip buyers were remaining extremely timid. So anytime we did get those opportunities, we just didn't see that buying materializing. That environment essentially rested on, I think, two bearish pillars: the extraordinarily hot run of data, which culminated in October with September NFP, CPI, retail sales print, and then finally that Q3 GDP number. And second was the huge amount of angst that markets had around the supply and demand for U.S. Treasuries. That drove a resurgence of this term premium theme that I think accounted for roughly 2/3 of the second half sell-off. But both of those pillars have started to crumble a bit in November. First we had the U.S. refunding announcement, which we did discuss in a prior episode. That relieved some of the concerns about U.S. Treasury supply. As Treasury kind of revised down their deficit expectations, pulled back a bit on longer end issuance. But then the data narrative started to crack a bit too. We had the softer than expected NFP print, a few weak ISM prints. We've seen a continued rise in continuing jobless claims. But to me, it's really last week's soft CPI print that solidified that turn in the narrative. I think if CPI had come in hot or really even on consensus, the market fears of breaking to new highs in rates. If you recall, several weeks ago, we were bumping up against that kind of 5% level in tens, a number of other key levels across the curve. I think fears of breaking above those would have probably persisted into year end without that CPI print. But as it stands now, I think it's extremely difficult to envision any kind of scenario that's going to take us back to those yield highs over the next few months. Even if we see data rebound into the December FOMC meeting, the context that the softer CPI print last week provides should make it pretty easy, I think, for markets and the Fed to look through any bounce on the data as really just noise rather than signs of a potential reacceleration. I think with that, markets have rightfully priced back in some 2024 cuts. We have year-end 2024 Fed pricing down almost 20 basis points over the last few weeks, and we have a total of about 4 25 basis point cuts priced for 2024. I personally think this still has some more room that could go. It's long been our view that the Fed cuts 5 times next year. Plus, I think there's always going to be this kind of long downside tail that needs to be accounted for in market pricing. Basically, if we see a hard landing and the Fed has to cut more aggressively. As for the longer term rates, I think we're in the process of settling to some relatively tight ranges for the remainder of the year. But I think there still could be a decent amount of chop inside of those ranges. I also think there's a bit of downward bias around those ranges. So if we're going to break them, I think at this point, it's much more likely we're going to break to the downside rather than to the upside. That's partially because, as I've been discussing, a lot of those sources of upside risk, mainly the supply concerns and concerns about a sustained reacceleration in the economic data, those have been clipped over the last few weeks. But also, I think, you tend to assume, I think, heading into year end, the positioning is going to continue to lighten up. And if so, I think that's a little bit supportive of yields, given that markets have been pretty heavily short for quite some time now. So let me go ahead and pause there, and let's go ahead and swing over to Jason Dahl to talk about BOC pricing and curves.
Okay, thanks a lot, Blake. So there's 2 interrelated items that I want to discuss. One, the wild swing in Bank of Canada pricing over the past month or so, and how that has affected the entire yield curve. So there has been a massive swing in the market's view on the path for the BOC. If we look back to just before the bank's October meeting, the market was giving a 50% chance of a hike by the January meeting, and it was firmly in the camp of the higher for longer theme, i.e. no rate cuts by mid-year. And that's drastically changed. And now the market's giving a 40% chance of a cut by March. It's fully priced for a cut by June and has almost 2 cuts baked in to July. So it does feel like the pendulum has maybe swung a bit too far, at least for rate cut pricing to April. We do think that the bank's first cut comes in Q3. Maybe it's a little bit earlier, but March, April seems a bit too early at the moment. But right now, momentum is strong. It's being reinforced by the CPI data that we've had this morning. And with the strong momentum, it's not really worth standing in front of the trend at the moment. But when the dust settles, there should be good value in paying the March or April contracts. And related, the move in front-end pricing has had direct implications for the entire yield curve. So the movement in bond yields, 2s, 5s, 10s, 30s, these have been highly correlated to expectations for the terminal rate for the Bank of Canada and especially 2024 rate cut pricing. So the drop in yields that we've seen from the peak a few weeks ago is wholly justified by what's happened with market expectations for the Bank of Canada swinging from possibly another hike to a long period of hold to now accelerating the rate cut path in 2024. So that has been consistent with what we've seen in the bond market. And we do think over the medium term that yield should edge lower, but the path is going to be choppy. The market's going to continue to grapple with the timing and magnitude of rate cuts, and this is going to swing the bond market around. But ultimately, rate cuts being delivered, probably 100 basis points in the second half of this year, that continuing into 2025 should provide a better macro environment for the bond market over the medium term.
Thanks a lot for that, Jason. And finally, let's head over to Peter to talk Europe.
Thank you, Blake. I also want to talk about essentially these two pillars that Blake has mentioned. I just want to reverse the order a little bit because it's very pertinent over here in Europe. So I'll talk about the fiscal side first, and then secondly, and therefore the supply of bonds, and then secondly, about the amount of rate cuts priced. So when we look at fiscal, it has obviously been a major contribution to the economy and economic growth, or the little bit of growth that we have over here in Europe. And we have essentially two fiscal events, one voluntary and one less voluntary, that's coming up. One is the UK autumn statement, or the budget announcement, that's taking place on Wednesday. And then the other bit is this announcement about the German Constitutional Court ruling some of the budget in the largest European economy as unconstitutional. So let's quickly tackle those two. So as far as the UK's budget is concerned, I mean, there is a little bit of leeway because the tax revenues have been better. And we expect that this will lead to a drop in the funding remit in the UK over here by around about 20 billion in gilts. That's slightly higher than what the market is seeing. We think the consensus is around about 13 to 15 billion. But, you know, and by and large, the market is tilting in the same direction. The bigger question, I think, is what is going to be announced in terms of tax reduction for the forthcoming fiscal year, because again, there is a little bit of leeway that the government has to fulfill its budget rules, and they're probably going to use it, knowing that we're also going into an election year. And there is quite a lot of speculation in the press at the moment about various rate cut options, inheritance tax, income tax, all of that. But it seems plausible at this stage to expect some of that will probably mean that the leeway for lower bond issuance going forward will be reduced somewhat. So that's taken place tomorrow. The other item that I just highlighted is that there was this ruling in Germany that the Constitutional Court essentially ruled out some of the budget arithmetic that the German government has put forth in its various so-called special funds, and in this one particular, the one tackling climate change. So essentially for this ruling, that means that 60 billion of spending that the government has put in cannot be happening within the current budget context. And what we're already sort of reading in the press is that new projects are currently being shelved, and the government is scrambling to get them back on the road. There's two problems with this that I see, or maybe two and a half. Let's start with the half one first, is that this is not the only special fund that the government has used. And there's other special funds that have essentially used the same arithmetic, and it seems at least plausible to expect that those will be challenged as well. And that means that the government has to come up with a different solution, and that different solution could either be finding a different way to fund it, or finding other items that it can reduce spending. And obviously, and this is maybe the last point on this, what this fundamental challenge highlights is that there is a big rift within the current government as well, where there's a coalition government and the Greens want to spend more money, particularly on the environment, whereas the Free Democrats, they want to prevent that and want to return to a much more, what they call a much more stable budget. And I think that this will create challenges going forward, not in the here and now, because over the next couple of weeks, it's probably unlikely going to affect the market, but certainly it will have some implications for expectations where the economy can go next year. And this is a good segue into the pricing of central banks, because just in line with all the other markets that we have just spoken about, we are pricing for the first rate cut, in the first half of the year, and we're pricing close to 100 basis points, a little bit less, both in the UK as well as in the Euro market, by the end of the year. And the biggest question that we are discussing with our clients in meetings is whether or not that comes to fruition. And one of the things that we constantly point out, that over here in Europe, the fundamental issue that we have is that base inflation, or domestically generated inflation, and no matter how you look at that, whether you look at core inflation or whether you look at service inflation, is still running relatively high. So as an example, in the UK, service inflation, which is typically a proxy for domestically generated inflation, is still running at about 6%, which means a contribution of 3% to the overall basket. Core inflation in Europe is still north of 4%. It's coming down, but it's coming down only slowly. And therefore, we have our doubts that by the time that the market is expecting the first rate cuts, and that inflation will have subsided sufficiently to give the thumbs up. In fact, we think that probably with a relatively strong labor market and relatively high wage gains in both of these economies, we reckon that the market will have to push out the first rate cut expectations much further into 2024 and potentially into 25. And we reckon that this will also prevent bonds and gilt yields from rallying much further, at least for the time being. That's what we are expecting.
Thanks for that, Peter. And thanks for dialing in. That wraps it up this week, and we'll see you again in December.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.